For an investor, this is what they should think about, and you've really done well on that, is look at it as bonds can create current income for every month of the year. We have 12 months in a year. So if your need is to create every month an income, then bond becomes one of the tools you can use to kind of give you that kind of current income. I will look at it from starting by the strategy of, do you want to be paid twice in a year? What are your obligations looking like? Where are you at as a person? What will this money do for you? And then now, because of your need, we work it back. Bond layering, or if you call it layering, has always been there.
Yeah.
I'll tell you this. My first bond layering client was 13 years ago.
Hello, welcome to another episode of Make Money the podcast, the show where we not only tell you but show you what's happening to your money and what could happen. And of course, this is all guided by conversations with the experts of money right here on the podcast. To introduce my guest for this week, it's important to introduce the topic we do have, and today we are going to talk about bond laddering. And effectively, if you ever wanted to assure yourself of a paycheck from the government every month from bonds, what you do is buy bonds over time that would assure you of monthly payments. So effectively, let me give you an example here. If you bought a bond in January, interest is due every 6 months. So effectively, you'd receive a payment within the month of June and January of the next year. If you buy another bond in February, effectively, you would be receiving an interest payment in the month of July and February of the next year. Now think about it, stretch this out over a year and see what it means. That means a bond in March would also pay you again in September, and again March of the next year. So effectively, around 6 bonds would assure you of a paycheck from the government every other month. And this is simply what bond laddering is. But if you'd go for a technical definition, I would like to pick out what Charles Schwab, this is an investment firm, says, and allow me to read here. A bond ladder is a portfolio of individual bonds that mature at different dates. And this is a strategy that provides current income to investors while also minimizing the exposure to interest rate fluctuations. Now that we've got the definition out of the way, allow me to introduce the guest for this week. And her name is Belinda Kiplimo, and she's the founder of Azara Wealth. Welcome to the podcast.
Thank you.
And I've made my best attempt at describing what bond laddering is, and also provided also a technical definition right there from Charles Schwab. Infusing my definition, my simple definition with that technical one, what are the key pointers or key takeaways on understanding bond laddering and why it's necessary?
They should think about, and you've really done well on that, is look at it as bonds can create current income for every month of the year. We have 12 months in a year. So if your need is to create every month an income, then bond becomes one of the tools you can use to kind of give you that kind of current income. So think about current income, think about individual bonds. Because now when you're coming in and considering to create current income for every month of the year, it means you'll have that kind of multiplicity. You can't get one bond just doing that. The other thing you also need to consider is the maturity. So say, for example, Kefa, let's fast forward you to 60 years, you're retiring, you're being given your retirement income. So you know next month is the last day of earning a current income from your employer. So what do you do with that lump sum? You multiply it by going into the bond, buying individual bonds, say 6 bonds, for example. And those 6 bonds, because they pay every twice in a year, then you know you will be able to earn January to December comfortably. So those are the main things we really consider. However, now that you're 60, we said consider the maturity. If you're 60 and we say you'll have another 20, 30 years to go, these bonds that you are considering out of the 6, will they be able to push you till 30 years? So if you're looking at a 2-year bond, it means at 63, you come back to the market. Those are the simple intricacies you need to think, but we are always there as advisors to help with that.
Bonds are not always the same. All of them will pay out a fixed return, so 12% or 13% or 14% depending on the bond you're holding. But we do know tax is usually different, so you have some bonds that attract tax at 10%, yes. Others are attracting at 15%. Then you have your risk interest-free bonds, which are infrastructure bonds where you basically don't pay any tax. We also know that bonds are different from each other in terms of maturity. So you have a 10-year bond, a 20-year bond, sometimes even a 30-year bond. We do see that in the market. How then do you go about picking to know that in January, maybe let me buy an infrastructure bond, which is tax-free? Or in February, maybe let me pick this other one. How do you ensure that you have the right mix? Or do you buy effectively similar type of bonds where you say, I'll only go for infrastructure bonds, I'll wait out to when they issued them, or I'll go out and buy a similar bond? Or can you mix it up? How do you go about selecting those different bonds?
I will say what we do in the market, because that's now easier to illustrate. If I can give an illustration. If you say you will only work with infrastructure bonds, let me actually start here where the government will come every month to issue a bond. And most of the bonds that are issued on a monthly basis by the government are the fixed income coupon bond. And those fixed coupon bonds have a tax to it. It could be 10%, it could be 15%. The infrastructure bonds are not as many. Yes, you can get 6 infrastructure bonds. Let me look at it, because we have a February one, we have June and December. That has been the tradition of our country. So you have 3 infrastructure bonds thereabout. So what happens to the other 3 months in the context of somebody looking for income? So it means you need to come back to look at the fixed coupon bonds. Now, the fixed coupon bonds, that's where now you can try to negotiate and see, out of all the fixed coupon bonds which are in numbers, what is the rate of each, and how much am I going to pay for it? Or am I getting into it, and I know we'll get into that, am I getting into it directly in the primary market, which will be a different price than if I wait for it to be closed over the time that the government gives? Then I come back to the market and say, okay, I want this bond later. We also look at it from this other angle, if I may say, and I'll tell a client, for example, how much income do you want to get? Or how much money do you have to invest?
Yeah.
So from that amount you have to invest versus the income you'd like to get, now we try to gauge what bonds are we able to. And some investors already know what it is they want to get. They say money market is giving me 10%. I want something between 10 and above. So it means we'll go to the market and look for bonds above 10%. So you see those criteria are different according to the investor's liking, or even how we are going to advise you what is available or what's available. Yes.
Belinda, when it comes to clothing, if I may use an example here, sometimes you mix and match it.
Yes.
Sometimes you wear monocolors. Sometimes you mix a bit. So when we talk about laddering for bonds, what's usually your go-to strategy, or what's the advice you give to client? Effectively, like you did mention, you have bonds that are tax-free, you have bonds that are 10 years, you have bonds that are 2 years, you have bonds that are 3 years. How does one really approach it? Is there a standard approach from your end where you say, maybe mix it up? As you said, it's not every time you go to market and find the bond you're looking for. But like you said, the government is coming to the market every month with a bond issue. And so do you just mix and match it and hope those colors work out for the target you did mention? And I like that you did mention that. Maybe sometimes the goal is looking at what you have or what you're looking to get over and above just looking for a specific type of bonds.
I wouldn't really call it a mix and match, because now it looks very
messy.
Sporadic. And messy. I will look at it from starting by the strategy of, do you want to be paid twice in a year? What are your obligations looking like? Where are you at as a person? What will this money do for you? And then now, because of your need, we work it backward. So if it's 6 months or it's every month I need money, then the strategy will be mixed for sure, because it means we'll mix a bit of the tax-free bonds, which is the infrastructure bonds, as well as the non-tax-free bonds, because you can't get everything in, say, a month. I'll tell you why I say you mix. Look at the same 60-year-old. You've been given your 10
pension,
million.
your retirement money, your gratuity.
Yes. You are happy, you want to spend it. Then we say we will wait every month for the government to release.
Yeah.
We do not know if the government next month will release October, say January, July bond.
Yeah.
They might decide to release February, August, but you already bought that. Or you already have 5 bonds, for example. You just have January, July that you've not gotten. So you might wait and wait and wait for that January, July to come until you spend that money. So why not just mix? And when I say mix, it's mix on both the type of the bond, which is, for example, the example we've given, infrastructure and fixed coupon, and also mix maturities, mix where you're getting it from. In the bond market, we have 2 types. We have the primary market, where the government has come and said for the next 2 weeks or for the next 3 weeks, there's these 2 bonds or there's this 1 bond that the government is issuing in the primary market. Anyone can come and buy into it. You might get some good prices there. When I say good prices, it's affordability is better there. Then there's the second one, which is the secondary market, which is every day. As long as it's Monday to Friday, 9 to 3, thereabout, the bonds are open for trade or they're available for selling and buying. So you do a mix where we look at, say, right now we have 2 bonds in the market for October. So you have your 60 years, you have your money right now, for example, that 10 million. We'll say, let's pick these 2 bonds first because you see these are low-hanging fruits.
Yeah.
Then the rest of the bonds, we go back to the secondary market and now go and search for them and combine them so that in another 2-3 weeks, you already have your bonds, you start earning immediately as they fall due for coupon or for interest, if we may use that word.
For some context here on the primary and secondary market, you have bonds issued by the Central Bank of Kenya, which would be the primary market. So this is every month. So every month we do expect the central bank to bring or offer those bonds for sale to investors. And you can buy there and get the return, the average return offered to investors. Then, of course, we have the secondary market where you buy from the Nairobi Securities Exchange and basically you are buying that bond from another investor. And, of course, there is the nuance of you either buy it at a discount or at a premium.
Yes.
And by a discount or a premium means if that bond is in demand, you'll pay more to hold the same bond. If that bond is not in demand as much from investors, then you buy it at a discount, meaning then your obligation here would be lower. And turning to that, I think it's something you've already segued here in terms of where do you buy your bond from. Knowing the risk presented by the secondary market, how much would you advocate for most people? I know retail investors will mostly go to the primary market where the return offered and the price you pay is very much determined. The secondary market can be messy because, again, we do know that whenever you're not transacting anything above 50 million shillings, then this is seen as a minor sale, and sometimes it demands that you take almost a hit as a retail investor. Would you really advocate for anyone going for the secondary market just to align those bonds best way they can?
There's this factor we call time. Again, going back to that, you already have 5 bonds, you're stuck with one that you're not getting in the primary market. It's just the others that are being repeated, which you already bought. And you have this cash, and it can be itchy. Cash that is not allocated can be itchy to spend. I advocate for secondary market. Why? One of the reasons and one of the things you will see even with central bank, with the coming up of the CSD, with the coming up of the central bank channel on social media, on Twitter, on WhatsApp, you get this information. And there's a lot of democratization, if I may call it, of knowledge and information that was not as available as it is right now. I'll tell you, for example, I am an ex-banker, and during the banking days, we had theory about bonds, I'd advise about bonds, but try to do that practically. You'd have to go to a department, the Treasury, or the department that does that fixed income. But now you are able to get this information on your WhatsApp. All the calculations of how much you're paying, how much the coupons will be till the day of maturity. So I do advocate for secondary market as well. And how I advocate for it, I look at it from this point. Say, which figure do we, give me a figure so that we can calculate.
Let's work with 100,000.
100,000 bond in the secondary market and the primary. So the primary, yes, you might get a discount depending again on the demand of the bond or at the same price. So 100 to 100 or 1 to 1. It's 100,000, then you end up paying 90,000 if it's on discount. Secondary market, the same bond. When it's closed on the primary, you might pay a little more. So let's give it even 120,000 shillings. This 20,000 shillings, this bond, how much is it paying you? Currently, we're doing between 12 to 13%. So if we take 12% interest or coupon for this 100K, it means it's 12,000. So with 2 coupons, for our January-July example, you have in Jan 12,000 and you have in July 12,000. You have 24. So it means you've already recouped the 20,000 you spent in the secondary market within a year, and you have about 4,000 shillings. So the second year of that bond, you are purely earning your coupon without these costs. So it's just a matter of looking at the time. Yeah. If I want to finish this and move on to another thing, because we are busy individuals, can I just mix this and then move on and start earning? Because some of this, you might buy a secondary, by then in the secondary market, for example, you might buy a bond today. Today is Tuesday. Bonds, coupons are paid on Monday. The same bond might be paying on Monday. You've paid your 20,000, yes, but you're getting 12K on Monday. Who wins? You've won on the time factor.
Yeah.
So do that mix. And don't be afraid to come to the market.
Another nuance here that's always a question I have is around the difference between maturities and looking at maturities, of course, and looking at the bond lengths. In a lot of markets, other people tend to focus on when the investment ends, basically the end of life for your bond. So if it's a 10-year bond, you have to think of a 10-year horizon. But sometimes others will only think about the monthly payment. So what you're getting in January, what you're getting in February, what you're getting in March. When does the focus turn to the maturity now to think, okay, maybe instead of a 2-year bond, let me buy a 10-year bond, let me buy a 20-year bond. Outside of the return, of course, and the return here will differ in terms of the interest rate you get on each paper. Should we be focusing so much on how long that investment will pay us for the monthly payments, or should we just focus on building that monthly payment, even if it's over a 2-year period, and then reinvesting that money back?
It depends. That's number one. But it's good to have both. Focus on the monthly income, but again, focus on the maturity. It's not bad to add a consideration on the maturity. Because if the bond is, say, maturing in 2 years' time, and then you're returned to your 100K in 2 years' time, and it happens to be the period we've just come from of the high interest rates, then you're in benefit, because it means somebody, say, who had a bond that was maturing, say, in 2 years, and he fell on, is it 2023 that we had our last infrastructure bond? Or was it 2024? So their bond, say, matured in November 2023.
Yeah.
And there was a bond that was coming up of 17.9%. So they immediately have 100K. Then this 100K, they reinvest at 17.9, and they've come from earning 12%. So you see, it's good to think about that. The idea shouldn't be being stuck on the maturity so much. You can have a bit of flexibility. Have some bonds that the maturity is long-term, because again, now you forget about, again, with the mention of people are busy. Have maturities that are longer, so that you don't have to keep on trying to figure out, when is my bond maturing, what is in the market that will be beneficial to me, all that information that you have to follow up. But also, you can also have some bonds that are short-term, for the sake of clearing your capital for other opportunities that you never know may come up.
I like the example you gave of rounding off your investments of 100,000 shillings at 12% and coming back right to the market to find 17%, meaning you're already walking into higher returns than you are making before. Now let's take an example of the reverse happening. You had your, let me even take it forward to February of 2024. We had an infrastructure bond of around 18.4%. So you invested in that, you get out, and you get back, again, our example here, we keep the same example of 100,000 shillings.
Yes.
So you've been earning around 18,000 every year from this paper at a return of around 18%. You come back to the market and it's 10%. It's
real, yeah.
It's real. What do you do? Do you wait till rates ever return there, or do you accept, like, hey, interest rates have changed, I might as well do with the 10%. So my 100,000 will only now make me 10,000 and no longer making me 18,000. What do you do? Do you hold your cards to yourself and hope for rates to change? And then the risk you said here is, you eating your money in quotes. Or do you just accept that, hey, this is where the yield curve is, let me roll with it and maybe hope for better next time?
Trying to time the market is very tricky. As you mentioned, the yield curve. In that case, you could either roll with the 10%, again, depending on your need. However, you can go to another opportunity, because now this is the thing about the markets and these investment tools. They never perform in the same way. So if you're finding the bond has come down to 10%, there's another opportunity within the market. So that's where diversification comes in. In this case, we are talking about 6 bonds, right? So you already have bonds that are giving you 5 bonds that are giving you income. Then you have that one bond that has matured. You have your 100,000. Why not diversify by looking for another opportunity in the rest of the market? For example, it could be bond. It could be stocks. Stocks at that time could be giving returns of multiples, 10, 15, 20, all the way we are seeing right now, even up to 200%. For the ones who had bought earlier. And even those who are buying now, we are still seeing even 20% return in a few days. So it's not being fixated. I know we are coming a little bit out of the bond conversation, but it's being a savvy investor and saying the yield curve has changed. The coupon I'm getting right now is 10% if I don't want to pay too high for it. The 18% that might be still there. This is the 18% that was already matured. So let's say the 17%, 17.9 is still there. But for you to get that 17.9, you'll pay an arm and a leg. Why not just diversify and go to another, even money market, for example, and use it as a parking fund as you wait for maybe some market movements to make, and then you come back to the bond market. Yeah. So diversify in that case. Yeah.
To close it off, I would like to have a sense of the demand from clients for bond laddering. I mean, if it was up to me and I would able to have every month I'm expecting something from CBK, a payment, more so a tax-free payment. If I could do that, I could have my 6 IFBs lined up for, say, 5-10 years and assure myself of that payment. But how great is the demand for bond laddering? I know this is relatively a concept that we are still learning about in our market here, but how big is the appetite for that from clients you speak to? What are you seeing out there?
Here is where I give you a bit of, is it advertisement? If you look at the Business Daily newspaper that is published every day, right? Up to Friday.
Yeah,
Monday to Friday. 2-3 years ago, at the back of it, I think you call the market news?
Yeah, we have the market pages.
The market pages,
data
right?
pages, yeah.
Yeah. So you look at all the bonds that are in the current market, the government bonds, and then there's a row, or is it a column? 2-3 years ago, that column used to be quite empty. But right now, if you open the same pages, that column is busy. It's very busy. So the market is very busy. There's a lot of uptake of bonds. There's a lot of buying and selling, not just of the traditional, institutional, or ultra-high net worth, but just even individual investors doing 100,000, 200,000, 150K. So there's a lot of activity that's coming up as also people are getting to know. I have to commend also the industry. We've really picked up on the tab of financial literacy and just making these concepts understood, yeah? Because you see, like bond laddering, or if you call it layering, has always been there.
Yeah.
I'll tell you this. My first bond laddering client was 13 years ago. I was a fresh graduate working in a bank and telling this retiree, let's go to the bank. Money market was not very clear. I mean, we think bankers know everything, but money market was not very clear in our minds. So I was like, you can do T-bills and T-bonds. That was my first client. But I mean, they have been there, here and there. But currently, the last 2-3 years is where I've seen a lot of activity and even just uptake. When you give it as an idea, it's being taken up again because I think the information is very clear. I can even say the DOS CSD has done a very big job in terms, the platform by Central Bank of Kenya has done a very big job in terms of just helping an investor be able at any one day to just be able to get into the platform, get to their system and be able to see the bonds, be able to see when the coupons are being paid and all that. And that democratization of information for me, I think is what I'm seeing now, reflecting on all the activities we are seeing in the bond market, which is really commendable and big.
That's Belinda Kiplimo. She's a financial advisor and also the founder of Azara Wealth. And I hope she's been able to impact some of your knowledge or ideas around investing in bonds and more so bond laddering. And for sure, if you wish to have a portfolio of bonds that pay you out every month, I hope you do have an idea of how to go about that. That is another episode of Make Money, the podcast by the Business Daily. My name is Kefa Muirore. Until the next episode, make sure your money works for you. Bye.